Let's get into the topic. What if I told you that 90% of retail traders lose money because they're trading against the banks and institutions? Today, I'm revealing the exact smart money concepts that professionals use to consistently profit in forex. Smart money concepts are a sophisticated approach to trading that helps you understand the true intentions of large financial players. It's about seeing the market through their eyes, not just reacting to price movements. By the end of this video, you'll understand exactly how institutions manipulate the market and how you can trade alongside them instead of being their victim. If you find this video helpful, then like and subscribe. First, let's define smart money. These are the big players, banks like JP Morgan, hedge funds like Citadel, and central banks. They control over 90% of the daily forex volume, making them the true market movers. Retail traders often lose because they're trading against this institutional order flow. While you're chasing breakouts, institutions are strategically positioning themselves, often leading to what feels like market manipulation. The key is a mindset shift. Stop chasing obvious moves and start thinking like these institutions. Anticipate their actions and you can trade alongside them. Now, let's dive into market structure, the foundation of understanding price action. We identify trends using higher highs, higher lows for bullish trends, and lower highs, lower lows for bearish trends. A break of structure, or BOS, signals trend continuation. If price makes a new higher high in an uptrend, that's a bullish BOS, confirming the trend is likely to continue. Conversely, a change of character, or ChoCH, suggests a potential reversal. If an uptrend suddenly breaks a higher low, it's a bearish ChoCH, indicating a shift in market sentiment. On the chart, we see an uptrend with clear HH and HL. Suddenly, price breaks below the last HL, forming a new LL. This is our ChoCH, a crimson red label appearing, signaling a potential trend reversal. Next, let's talk about order blocks. These are crucial zones where institutions place massive buy or sell orders, often leading to significant price reactions. A bullish order block is the last down close candle before an impulsive bullish move. A bearish order block is the last up close candle before an impulsive bearish move. Price often returns to these order blocks to mitigate institutional orders. Identifying them allows us to anticipate where price might reverse or find support, check resistance. Here's an example on USD. Notice how price returns to this bearish order block, highlighted in red, before continuing its downward trajectory. These are high probability reversal points. Now, fair value gaps, or FVGs. These are inefficiencies in price where the market moved too fast, leaving an imbalance. Institutions love to fill these gaps. You spot them with a 3-candle pattern. For a bullish FVG, the high of the first candle is below the low of the third candle. For a bearish FVG, the low of the first candle is above the high of the third. The trading strategy is to wait for price to return and fill these gaps. Institutions often use these areas to rebalance their positions. Let's look at liquidity grabs, also known as stop hunts. Liquidity clusters where stop losses are placed, typically above highs and below lows. Institutions will often sweep these liquidity zones, pushing price just beyond these highs or lows to trigger stop losses before reversing the market. This is a classic fake-out pattern. By understanding this, you can avoid being trapped and instead profit from these reversals. Now let's put it all together into a step-by-step SMC trading setup. First, identify the market structure and trend. Second, mark key order blocks in the direction of the trend. Third, spot any fair value gaps within or near those order blocks. Fourth, watch for liquidity grabs that align with your anticipated move. And finally, enter on confirmation, often a smaller time frame, break of structure. Let's walk through an example trade. Here on USD H4, we have a clear bullish market structure with a break of structure. We identify a bullish order block and a fair value gap within it. Price then sweeps liquidity below a previous low, creating a perfect setup. We enter at the order block.FVG, place our stop loss just below the liquidity sweep, and target the next significant high for our take profit, aiming for at least a 1.3 risk-to-reward ratio. Remember, risk management is crucial. Always risk only 1 to 2% of your account per trade. This protects your capital. So, to recap, you've learned about order blocks, fair value gaps, and liquidity grabs. These are the core smart money concepts. You now understand what 90% of traders don't. This knowledge is powerful, but it requires practice. Start by practicing on a demo account and backtesting these concepts. The more you apply them, the clearer the market will become. If you found this valuable, smash that like button and subscribe for more institutional trading strategies. Drop a comment telling me which concept confused you most. I read and reply to every comment. And if you find this video helpful, then like and subscribe. Next video, we'll cover the exact entry triggers I use with these concepts. Don't miss it.